Hi, I'm Jimmy. In this video, we're looking at what is keeping the stock market up at this point and what could very well be the cause of the next stock market crash. Okay, so I'm sure we can all agree that the stock market has been on a very serious run for a very long time. But the question is, when is it going to end? We all know that the stock market is going to crash at some point, like it has many times before. Obviously, trying to determine when it will happen is far trickier. So in my last video I did on the repo market, where the Fed is pumping a ton of money, last I heard up to $100 billion a day into the banking sector. Well, my conclusion there was, although this was interesting, at the end of the day, I don't think that this is a short-term problem, that will be the trigger for the stock market crash, but perhaps it will be a problem in the longer run. But it's not like we use that information in isolation. We also do a monthly piece called Should We Invest Now or Wait for a Stock Market Crash? And in that series, we look at some leading economic indicators to try to gauge what's happening with the economy and where we think the market's going to go. I've got a link in the description below to that whole series if you're interested. And I'm actually coming out with another video very soon. We're doing it at the beginning of each month. But the summary of the last video in that series was that there are a handful of negative economic signs and there are very few positive economic signs. Now, we use a scorecard like this in each of the videos. This is the one from the last video. So between our most recent video on the Fed entering the repo market to try to help the banking sector and our monthly series, it seems to be that most information is pointing towards a stock market crash happening sooner rather than later. Yet here we are with the stock market up near all-time highs. So what if we were to switch our question around a bit? Instead of trying to identify the different pieces and looking at what could make the stock market crash, what if we were to instead switch it to what is keeping the economy up? What is keeping the stock market up this high? My first thought is the government seems to be assisting a few things. We saw that when they stepped into the repo market. Plus, they've been lowering interest rates. So clearly, the government isn't hurting things too badly at this point, not just yet. But I don't think that that's what's been keeping things rolling along. At least, it's not the reason that the stock market hasn't crashed yet. Not so long ago, the Fed was raising interest rates and selling assets on their balance sheet. So from the data I could find, and where economists seem to agree, is that it seems that the average consumer, or consumer spending, is keeping the economy growing nicely. And this actually makes a lot of sense if we think about it. Manufacturing has been down recently. Housing has seen a few hiccups in the past year or two. Clearly, the bank needs some help, and that's obvious with the Fed stepping in to help the repo market. So our question is, do we think that it's the consumer keeping things up from an economic standpoint? And what if they stop? Does that send the stock market into a tailspin? I think it could, and there are a few things happening right now that could be the early signs of the consumer weakening. Now, of course, if manufacturing were to start picking up or housing began to do much, much better, perhaps that could offset a dip in strength from the consumer, and we'll dive into that in the monthly economic analysis series that we do, link in the description below. But for now, let's just focus on the consumer for the moment to see if we think that the early signs of turn lower is actually peeking its head out. So this is a chart of consumer confidence, and although the early numbers for September are in, they look a little bit stronger than last month. Clearly, things have pulled back slightly from the top. Now, this is a volatile indicator, so we want to take that with a grain of salt, but I'm curious to see how this shakes out over the next few months and what impact, if it continues to fall, that could have in the economy. But the economy in the US, or even the US stock market, is affected by much more than just the US consumer. So if we were to take a quick trip around the globe at some of the larger economies out there, well, here's Japan's consumer confidence. And as we could see, it's been a rough year for the consumer in Japan. When we jump over to Germany, we see a very similar story. These are year-over-year numbers, and clearly they've been dropping rather quickly. Now, again, we shift over to the United Kingdom. This one we probably could have guessed, given the whole Brexit situation. Well, clearly, the consumer isn't all that confident over in the United Kingdom right now. Now, I'll admit, out of these four countries, it seems that the US consumer is doing the best. And when we isolate just the US consumer chart once again, well, we can see that the US consumer it seems to have been fairly confident over the past couple of years relative to the other countries. So they seem to be okay with the economy and their personal economic situation in general. Now, this is where it gets interesting, or at least it could get interesting. And perhaps this may have been where I was wrong in the last video when we talked about the Fed injecting the liquidity into the repo market. I said that I didn't think that would hurt things. I didn't think that would tip things over. Maybe I was wrong, although not for the reasons I was originally thinking, more about how I was thinking about it. What if the Fed injecting capital is just another proverbial straw on the camel's back after a series of straws being piled on to the consumer and their ability to continue to buy? Off the top of my head, I'm thinking of things like the trade tensions or general political instability, not just in the US, but in many cases around the world. Brexit is a good illustration of that. So in my mind, a lot of this comes back to the primary thing that seems to be keeping the economy floating, and that's the US consumer's ability to buy and sell goods and services. Goods and services in the United States account for about 2/3 of GDP. This is a chart of consumer spending on goods and services from a month-to-month basis. How much they change from the previous month? And just a few days ago, the August numbers came in, and they came in at 0.1%. I'll make that a little bit wider so we can see it. But this is worse than what economists were expecting. Economists were expecting a 0.3% increase. Now, I'm not a big fan of overreacting to any one number or any one piece of data, and I think that the economy in general is complex enough to make any decision off of any one piece of information. So this item alone, we'll call it a speculative piece of data at best. But I bring this out because what if between the trade tensions and the political unrest and the Fed needing to step in to assist the banks in the repo market, well, what if all these straws being stacked up are simply enough for the consumer to say, all right, I'm not too sure what's going on now. Consumer confidence continues to slide. If the US consumer simply decides to spend less, or maybe save more, or maybe pay off some of their credit cards, or maybe they don't do anything and they just don't put anything new in their credit cards. Well, if the consumer is what's keeping the economy propped up, and don't forget, the US consumer spending on goods and services accounts for 2/3 of GDP. Well, if they get spooked enough to stop buying things and try to protect themselves and save a little bit of money, well, if that happens, maybe that's what sends the economy over the edge. Much of the world, especially in the US, has seen a very long bull market. And if enough people believe that the end is near and the end is coming, and they start showing that belief by spending less and saving more, well, what happens next? Now, I recognize that I may be stretching a little bit here. I just don't want to be blind to the fact that if we analyze each brick independently, that may be a mistake because each brick could be fundamentally sound. The Fed injecting capital into the repo market by itself isn't that bad, but when you stack those bricks 100 bricks high, it could end up being a bad thing. And frankly, it's a big one at the bottom holding the whole thing up, the US consumer. So what if that were to fall? Well, things could go very wrong very quickly. Now, very few people really want the stock market to crash, except maybe the die-hard value investors. So I expect for the Fed to stay in there. They're going to keep lowering interest rates, and they're going to try to kick the can down the road and keep the bull market going. Will it work? It's tough to tell. And frankly, I'm not sure there's an easy answer to this. I think it may make sense for us to stay defensive with our portfolios and look for opportunities to pick up great value opportunities if we do see a pullback. I don't think a pullback in the stock market is to be feared. But what do you think? Are we at the beginning of a real crash in the stock market and the US economy in general? And I think if that happens, it's likely to spread around the world just like 2008 happened. Please let me know what you think in the comments below. And if you're new to this channel, please hit the subscribe button, the bell icon so you can get notifications whenever we update the channel. Thank you for sticking with me all the way to the end of the video. I'm really curious to see your comments, so please put them below. Thank you, and I'll see you in the next video.